Nobody told you the truth about support and resistance. They gave you a ruler, a few YouTube tutorials, and a color-coded chart, and they called it an education. They said draw a line at the old high, draw a line at the old low, and wait for the price to bounce. Simple, clean, logical. And for a while, it almost feels like it works. You draw your lines, you place your trades, you tell yourself, this time you have found the edge. And then the market walks right through your line, like it was never there, takes your money, and moves on without a pause, without an apology, without a single acknowledgement that your carefully drawn level even existed. You sit there, staring at the screen, confused and angry, wondering what you missed. I am going to tell you exactly what you missed, but I warn you, what you are about to hear is not what the courses teach. It is not what the textbooks say. It is what the market itself teaches you after it has humbled you enough times that you finally stop defending your beliefs and start actually paying attention. I spent the better part of my life in this market. I was there when fortunes were made and destroyed in a single afternoon. I watched brilliant men with more capital and more intelligence than most people will ever have access to, draw their lines with conviction and get wiped out when price ignored every single one of them. I lost everything myself, more than once. And each time I rebuilt, I did not rebuild by finding a better indicator or a smarter system. I rebuilt by understanding something that cannot be charted, cannot be backtested, and cannot be taught in a seminar. I rebuilt by understanding people, because that is all the market is, a crowd of human beings, each one carrying their own history, their own pain, their own hope, expressing all of it through the only language they have available, the price at which they are willing to buy or sell. Support and resistance at their core are not technical constructs, they are psychological monuments. They are places where the crowd paused, where a battle was fought, where a decision was made that changed the direction of price. And the reason they matter is not because a chart printed a line there. It is because the people who were there remember it. They carry that price with them. And when price returns, they react. That reaction is what you are actually trading. When you trade a support or resistance level, you are not trading a line on a chart. You are making a bet on how a crowd of human beings will behave when confronted with a price they remember. If you do not understand the crowd, you cannot understand the level. It is that simple and that complicated. Think about what actually happens when a stock rises to a level and turns down. A textbook will tell you supply entered the market. That is technically accurate, but it explains nothing. You need to ask the question beneath the question. Why did supply enter at that specific price? Because the people who bought lower have been holding for weeks, watching the number climb, waiting for their chance to exit with a profit. And at that level, enough of them decided the time had come, because the traders who shorted it at the top on the previous visit are finally seeing their conviction validated and are closing their positions. Or because the traders who watched this stock run and missed the entire move decided that here, at this price, was where they were willing to bet against it. All of those people, all of those emotional states, all of that accumulated history, it all converged at one price. It is not a line, it is a collision of human decisions, and it shows up on your chart as resistance. Support is the mirror of that same dynamic. When price falls to a level where it previously found buyers and it finds buyers again, you need to ask why. Because the traders who were there last time and made money remember the feeling. They want it again. Because the traders who missed the move last time and spent weeks watching it run without them are now finally getting their second chance, and they are not about to let it slip by. But because traders who bought at higher prices and got stopped out or scared out are now watching from the sidelines and have made a quiet promise to themselves that if it ever comes back to that level, they will get back in. All of them are watching the same number. All of them are ready to act the moment price touches it. And when price touches it, they act together. That collective action is what you see on the chart as a bounce. It is not magic. It is not some invisible force in the market. It is the concentrated emotion of a crowd expressing itself all at once. And if you can understand that crowd, you can anticipate that expression before it happens. Most traders treat support and resistance as binary events. The level holds or it breaks, the trade works or it doesn't. But the market does not operate in binaries. It operates in pressure and time. A level is not a wall. It is a zone of accumulated tension. Think of it like a dam. The dam does not hold because the concrete is perfect. The dam holds as long as the water pressure behind it does not exceed what the structure can bear. And that calculation changes every moment. New water comes in, old cracks form, the temperature shifts. The structure itself settles and weakens over time. A support level is the same. It holds as long as the buyers who remember that price are still in the market, still holding positions anchored to that level, still emotionally committed to the idea that it represents value. The moment that crowd disperses, the moment those buyers have moved on or given up or been replaced by a new crowd with no memory of that price at all, the dam has no water behind it. And when price approaches with force, there is nothing to stop it. I learned this in the commodity pits in the early part of my career. I watched men who knew every technical pattern ever drawn, men who had been in the markets for 20 years, step in to buy a classic support level with absolute certainty and get annihilated when price kept going. The level was real in the sense that it had been significant in the past. It had held multiple times. It was drawn on everyone's chart. But the underlying story of the commodity had changed. The conditions that created the original buying pressure at that level no longer existed. The crowd that had defended it was gone. New participants had come in with no emotional attachment to that price, and they did not behave the way the old crowd would have. The level was a ghost, and it looked alive on the chart, but it had no pulse. And stepping into it like it still had the force it once had was like leaning against a wall you did not know had already crumbled. I paid for that lesson more times than I care to count before I finally internalized it. A level is only as strong as the memory behind it. When the memory is gone, the level is gone, even if the line is still drawn on your chart. So how do you know the difference between a level with real memory behind it and a level that is already dead? The first thing you look at is volume. Volume is the market's confession. It tells you how many people were involved at a price, which tells you how many people carry an emotional stake in that price. When a level forms on enormous volume, so when a massive number of contracts or shares traded hands in a short window around a specific price, the memory at that level is deep. The crowd is large. Many people made decisions there. Many of them are still holding positions anchored to that price, watching, waiting, ready to act. When price returns to a high volume level, you are walking back into a crowded room. Everyone turns to look. The level has teeth. Contrast that with a level that formed on thin volume, maybe a brief touch during a quiet session, a small candle, barely any activity. Very few people were involved. Very few people remember it. When price returns, the room is empty. Nobody turns to look. The level dissolves without resistance. Volume is not just a confirmation tool. It is the measure of how deeply the crowd's memory is embedded in a price. Time is the second thing you must consider, and it is the one most traders completely ignore. Memory fades. Not all at once, but gradually as the original participants rotate out of their positions, as new traders enter the market who were not there for the original move, as the story of the stock or the commodity or the index shifts beneath the surface. A level from 3 years ago may still be visible on your chart, but the crowd that created it is mostly gone. The people who bought there, who shorted there, who got stopped out there, they have moved on to other trades, other markets, other lives. Their emotional attachment to that price has dissolved. What remains is sometimes something even more powerful and sometimes something completely hollow. Legendary levels, the ones that every generation of traders learns to watch. They can survive precisely because so many subsequent generations of participants have collectively decided they matter. The level becomes a self-fulfilling memory, sustained not by the original crowd but by the shared belief of every trader who has ever studied a chart of that market. But most levels do not achieve that status. Most levels are sustained only by the traders who were actually there, and once those traders are gone, the level is gone with them. Before you trade a level, you must ask yourself whether you are trading original memory or legend. The answer changes everything about how much conviction you should bring to the trade. Now let me address something that trips up nearly every trader who has studied even a modest amount of technical analysis. The idea that support becomes resistance and resistance becomes support. You have heard it, you probably believe it, but most people who apply it do not actually understand why it is true. They apply it as a rule without understanding the mechanism, and that means they apply it in the wrong situations and wonder why it keeps failing them. Here is the mechanism. When price breaks below a support level, every single person who bought at or near that level is now holding a losing position. They are underwater. And the human mind, when it is holding a loss, does not think rationally. It does not say, "I was wrong, let me cut my loss." It waits. It tells itself the trade will come back. It makes a silent, desperate promise that if price just returns to the entry point, the loss will be erased and they will get out. They will not do anything brilliant or aggressive. They will simply exit, relieved to have their money back. Now, when price does rally back up to that broken support level, all of those trapped buyers start selling. Their exit becomes supply. And that supply is motivated not by profit, but by pain. Not by opportunity, but by desperation. It is heavier and more relentless than normal selling pressure because it is driven by the most powerful force in human psychology, the need to avoid a loss. That is what turns support into resistance. It is not a market law, it is not a mystery. It is human psychology operating exactly the way you would expect it to if you stopped treating the market as a series of patterns and started treating it as a mirror of collective human emotion. Understanding this will save you from one of the most common and most expensive mistakes in trading, or which is buying a level that has just broken and rallied back to test it from below, thinking you are buying a bargain, not realizing you're walking straight into the exit of a crowd of trapped sellers who will sell you everything they have the moment price gives them the chance. The practical application of all of this is what separates the traders who survive for decades from the traders who blow up and walk away blaming the market. When I identified a level that had the characteristics I was looking for, significant volume, reasonable recency, clear emotional context from the price history, I did not simply place an order there and wait. I never did that. Placing an order at a level and waiting is what amateurs do. It is the equivalent of arriving at a battlefield, taking your position, and then closing your eyes. I watched. I probed. I paid attention to how price was behaving as it approached the level, because the approach tells you almost everything you need to know about what is about to happen. If price was coming into the level on declining volume, the move was exhausting. The sellers or the buyers driving it there were running out of ammunition. That was a potential setup. If price was approaching on expanding volume, something aggressive was behind the move. A large participant was driving it there with force. That kind of approach usually means the level will not hold. The pressure is too great. The crowd on the other side is not going to be enough. I was watching for hesitation. I was watching for tight, indecisive candles forming just before the level, indicating uncertainty, which in the right context means the dominant direction is pausing or not reversing. I was watching for any sign that the level still mattered to the current participants, not just to the ghosts of traders past. And I waited until the market itself, through its own behavior, told me the level was likely to hold before I committed meaningful capital to the trade. This patience, this willingness to wait for confirmation rather than act on anticipation, was not glamorous. It did not generate interesting stories, but it was the single most important discipline in my survival as a trader. There is another dimension to this that very few traders ever talk about honestly, and that is the role of the large operators, the institutions, the funds with enough capital to move markets by themselves. Because here is something I understood early, and that cost me money until I did. The obvious support and resistance levels, the ones drawn on every retail trader's chart, the levels that everyone knows about, those are not just battle lines. They are hunting grounds. The large operators know exactly where the crowd has placed their stops. They know because the crowd is predictable. Every trader who bought above support has placed their stop below it. That is what the textbooks tell you to do. And when every trader does what the textbook says, you end up with enormous concentrations of stop orders clustered just below every obvious support level and just above every obvious resistance level. And the large operators know this. They have the capital to drive price into those stops, trigger them, collect the liquidity, and then reverse course. They shake out the weak hands, not out of cruelty, but out of necessity. Or would they need that liquidity to build or exit their own massive positions without moving the market against themselves? What looks like a breakdown is sometimes a harvest. What looks like a breakout is sometimes a trap. And the only way to tell the difference, and you will not always be able to, is to watch what happens after the apparent break. Does price keep going with conviction, or does it stall, reverse, and reclaim the level it just broke? The reclaim is the tell. When price breaks below support with what appears to be momentum and then reverses sharply and closes back above the level, you are likely looking at a stop-running operation followed by a genuine reversal. The real buyers, the ones with conviction, came in after the stops were cleared. The level, having been tested and defended at the most extreme point, key often launches the most powerful moves of all. I called these springboard setups, and some of my largest gains in my career came from reading them correctly and having the nerve to step in when everyone else was running for the exit. What connects everything I am describing, the volume analysis, the time assessment, the psychology of trapped traders, the mechanics of stop runs, is a single underlying idea. You are not analyzing a chart, you are analyzing a crowd. Every piece of information that chart contains is a record of human decisions made under conditions of uncertainty, greed, and fear. The chart is a transcript of those decisions, and like any transcript, it tells you both what was said and, if you read carefully, why it was said. When you start reading a chart the way you would read a crowd, you stop treating levels as lines and start treating them as stories. A story with many participants, each with their own reasons, each with their own emotional stake. Some of those participants are still in the story, some have left. Your job is to figure out who is still there, what they are feeling, and what they are likely to do next. That is not a technical skill, it is a human skill. And that is precisely why most traders never develop it. Most traders want a system. They want rules they can follow without having to think, without having to feel, without having to be wrong and learn from it. The market will never give you that. The moment a pattern becomes widely known, the moment a rule becomes widely followed, the market begins to work around it. The only edge that never becomes obsolete is the edge of understanding human psychology, because human psychology does not change. Fear and greed have been constant in these markets since the first commodities were traded. They will be constant long after every algorithm and every AI ever built has come and gone. Let me tell you something about discipline, because the word gets thrown around so often in trading circles that it has lost most of its meaning. People think discipline means following your rules. That is part of it. But the deeper discipline is this, the discipline to wait until the market is doing what your thesis says it should be doing before you commit to the trade, not before you think it is about to happen, before it is actually happening. I missed hundreds of trades in my career because I was waiting for confirmation that never came. I do not regret a single one of those missed trades. What I regret are the trades I took before the market confirmed my thesis, because I was impatient, because the opportunity looked so obvious I could not imagine it failing, because I had already calculated the profit in my head and I was eager to collect it. Those are the trades that hurt you. Not the ones you miss, the ones you take too early. The market is not on your schedule. It does not care that you have been watching a level for 3 weeks. It does not care that you are ready. It will test that level when it is ready, when the conditions are right, when enough pressure has built on one side to create the kind of reaction you are looking for. But your job is to be present when that moment arrives, not early, present. I want to speak to the traders in this audience who have been damaged by the market. Not financially damaged, though that too, but psychologically. The traders who have lost confidence, who second-guess every entry, who cut winning trades short because they are afraid the profit will disappear, who hold losing trades too long because admitting the loss feels like admitting failure. I was that trader. I know exactly what it feels like to buy a support level with complete conviction, watch it break, hold on hoping it will come back, and then finally sell at the absolute bottom just before the real bounce happens. I know what it is to short resistance and watch the price grind higher for days while your account bleeds and your certainty slowly turns to doubt and finally to despair. Those experiences do not mean you are bad at this. They mean you are human, and they mean you are trading without understanding the full picture. A broken level is not a defeat, it is information. The most valuable information the market ever gives you is information about what it is not going to do. When a level that should have held breaks instead, the market is telling you the story has changed. It is telling you the old crowd is gone. It is telling you new participants with new convictions have taken control of the narrative. That is not a failure of your analysis. That is the market updating itself. Your job is to update with it. Take the small loss. Step back. I reassess. Find the new story the market is telling and figure out where the new crowd is gathering. That is how you survive long term. Not by being right, but by being responsive. The traders who last in this market are not the smartest. They are not the ones with the best charts or the most sophisticated systems. They are the ones who have developed the ability to be wrong without being destroyed and right without becoming arrogant. They carry their losses lightly and their lessons heavily. They are not attached to their opinions about where price should go. They are attached only to what the market is actually showing them in real time. And the tool they use to stay grounded in that reality, more than any indicator, more than any pattern, more than any rule, is self-awareness, the knowledge of their own psychological weaknesses, the ability to watch their own emotional reactions to the market's movement and catch themselves before those reactions lead to decisions they will regret. Support and resistance analysis, done the way I am describing, is partly a technical skill and mostly a self-discipline practice, because every time you approach a level, your mind will try to tell you a story. It will tell you this level is significant. It will tell you the bounce is coming. It will pull you toward a trade before the trade is ready. And your job is to hear that story, acknowledge it, and then wait. Wait until the market itself confirms the story before you place a single dollar behind it. There is one final thing I want to leave you with, and it is the thing that took me the longest to learn. The thing I wish someone had told me in the very first year I ever placed a trade. The market is not your adversary. It has no interest in taking your money. It has no awareness of your positions or your hopes or your stops. It is simply the aggregate expression of millions of human beings all making decisions simultaneously, driven by all the same fears and hopes that drive every human decision. Your job is not to beat the market. Your job is to understand the crowd well enough that you can anticipate where collective human behavior is likely to take price next. And support and resistance are the most powerful windows into that collective behavior that this market offers. They show you where the crowd paused. They show you where battles were fought. They show you what prices people remember, what prices carry emotional weight, what prices will activate responses when touched again. They are the market's memory made visible. And if you learn to read that memory not as a collection of lines, but as a living record of human experience, you will trade with a clarity and a patience that most traders never develop. Every level you draw from this moment forward should come with a question attached to it. Who put this level here? What were they feeling? Are they still in the market? What will they do when price returns? Those questions will keep you honest. They will keep you out of the ghost levels, the ones that look significant on the chart but have nobody standing behind them. They will point you toward the levels that carry real weight, real memory, real crowds waiting to act. And when those levels are approached in the right way, with the right volume behavior, with the right price action confirmation, that is when you step in, not with hope, not with anticipation, with conviction that has been earned through observation and patience and the willingness to be wrong 100 small times in service of being spectacularly right when it matters. The market will open tomorrow. The same crowd will be there, carrying the same fears, the same hopes, the same memories of the prices that change their fortunes. The levels that matter will matter for the same reasons they always have. And you, if you carry what you have heard today into the next session and the one after that, will begin to see things in that market that were always there, but that you never had the eyes to find. Not lines on a chart, people, their fear, their greed, their memory. Read those and you will never need to wonder again why the market moved the way it did. You will already know because you will have stopped looking at the chart and started looking at the crowd behind it.